What's going on, y'all? Brandon from Vegas. Obviously, I'm here with my partner, Nika. Welcome to the Won't You Be My Neighbor podcast, where we discuss real estate, dating, and everything in between. Today's class is on the FHA loan. There are so many misconceptions and misunderstandings about the FHA loan, and we're going to clear them all up. Nika, when you work with buyers, would you say majority of them are FHA buyers or conventional buyers?
I'd say they're pretty much half and half.
Half and half?
Yeah.
Good for you. I get a lot of FHA loan buyers. Those are my people. I got FHA loan people. Yeah.
That's cool. I have love for FHA too, so.
Yeah. Yeah, it's a little bit harder work, right? Because there are people who may have higher debt to income or less to put down, but they're still good buyers. They're still active. They're still ready to get after it, right?
I think what the biggest challenge with FHA is a lot of the FHA buyers, they want just a little bit more than
they can afford.
Yeah.
That's okay. That's actually going to be the focal point of our real estate is dating segment later, is how FHA buyers often want more than they can afford. So stick around for that. All right. So why would someone choose an FHA loan over a conventional loan? Why? What would be the point? Well, let's go over it. FHA loans are less picky and easier to qualify for. What do I mean by that? I'm going to show you guys right here. When you have a conventional loan, they'll typically want a 640 plus credit and 40% debt to income ratio for a conventional loan.
They want that A1 credit.
They want really good credit. They want good debt to income. For those of you who don't know what debt to income is, it's how much money you make per month. Okay. Then you take how much you're spending on debt. By debt, we mean car loans, car payments, insurance, alimony, child support, student loans, credit cards, personal loans. You take all of your monthly debt, your Netflix accounts, all your monthly debt, and then you divide it by how much you make per month. So if you make $5,000 per month and your monthly debt is $2,000, you would take $2,000, divide it by $5,000, and that is your debt to income ratio. All right?
Excluding your rent, excluding your utilities.
Yes, your rent and utilities are not a debt because when you buy a home, your rent is going to become your mortgage and your utilities will become your bills, right? Easy peasy. So the FHA loan doesn't need a 640 credit or a 40% debt to income. The FHA loan can do it with 580 credit and up to 50% debt to income. These numbers behind me are crazy, you guys. 50% of your income can go to debt and you can still qualify for the FHA loan. Now, I'll tell you the truth. If you're coming in with a 580 credit score, you are going to get a garbage interest rate. Okay? I'm not here to trick you. I am not a con man. I'm not a snake oil salesman. Anybody who tells you that you can get a home with a 500 credit score, they're not telling you that it's going to be very expensive to do so. What I tell people is whether you're going for an FHA loan or a conventional loan, you still want to hit that 640 credit mark to make sure you're getting a very good interest rate. Okay? So, a few more facts about the FHA loan. Nika, you got something to tell us about the FHA loan? FHA loan facts. Let's go with that.
The FHA loan, so you can't just get a $800,000. You won't qualify for an $800,000 house.
Yes.
It goes up to 420. Is it 420 or 430?
Well, the best news is in Vegas this year, it just went up to 495,000,
which is nice.
So that's the first FHA loan fact. It varies from city to city. So even here in Las Vegas, it varies from county to county. If you're in Clark County, the amount is 495. And if you're in Elko, if you're in a different county, the numbers will change. The best example for this is if you're in San Francisco, the FHA loan is up to like $900,000 because even a basic ass starter home in San Francisco is $900,000.
That's crazy.
Where here in Las Vegas, it's $495. So your FHA loan is going to vary by the income of your city. Does that make sense to everybody? Good. So it varies from city to city. We already covered 580 credit minimum. We already covered 50% debt to income. Here's some other fun facts about the FHA loan for you guys. You can't rent out the house for the first year.
Has to be your primary residence.
Has to be your primary residence. There's a gigantic loophole to this, guys. There's a gigantic loophole to this, and it is called Airbnb. For those of you who always wondered how Airbnb got so popular, the answer is pretty simple. You could take out an FHA loan on a property because it's your primary residence, and then you could rent out a room in that property on Airbnb, because Airbnb isn't renting a house, it's sharing a house. That's the great loophole. When someone's Airbnb-ing your house, they're not renting it, they're sharing it. Airbnb got popular because of a gigantic loophole, and it has been successful for them ever since. One last fact about the FHA loan that all of you need to be aware of. It is called mortgage insurance premium. Okay. How many of you guys have heard about PMI? Raise your hand. Who here has heard the phrase PMI? Oh my God, I got to put 20% down, or PMI. I got to put 20% down, or PMI. I got to put 20% down, or PMI.
Everyone's raising their hands.
I know.
Yes, they heard about it.
Yes. Mortgage insurance premium is like PMI with one huge difference. It never goes away. Mortgage insurance premium is the AIDS of the real estate world. Okay? The government basically said, we will give you this loan, but you are going to get mortgage insurance premium for the lifetime of this loan. No matter how much money you put down, no matter how much of this mortgage you pay off, you are going to be paying the mortgage insurance premium. So the question is, why would we take an FHA loan if it has mortgage insurance premium for the life of the loan? The answer is pretty obvious. It's easy to get into. And Nika, what can you do with the FHA loan?
It's less down payment.
It's less down payment, and you can refinance it. There you guys go. This is another loophole with the FHA loan. You can't get rid of the mortgage insurance premium on your FHA loan, but you can refinance it. You can refinance into a conventional loan. This will eliminate your mortgage insurance premium. Now, some of you out there may be a little smarter than the rest, and you might ask yourself, well, Brandon, why wouldn't I just go with a conventional loan in the first place? And the answer is obvious. Some of you mother truckers don't qualify for a conventional loan. Just being real. Some of you guys will not qualify for a conventional loan. Your credit may be lower than it needs to be. Your debt to income may be too high because y'all spending too much money on Starbucks and Netflix and all the bullshit. You may have crazy student loans, right? You may have things that don't let you qualify for a conventional loan. But that doesn't mean that you should continue renting when the FHA loan is such an easy and obvious outlet, right? Let's keep going. So, what does it take to refinance? What does it take to refinance the FHA loan? Nika, have you ever done a refi on an FHA loan yet?
Nope.
No refi? Let me tell you guys right now, to refinance an FHA loan, it's as simple as this. You need 20% in cash and or equity, okay? The big thing for you guys to see here is the word and or equity. A lot of you guys are rushing out and trying to save 20% down to put on a home. And I'm here to tell you, putting 20% down is one of the dumbest ideas people have with modern real estate, right? Nika.
It's always what your parents tell you to do.
Yeah.
Too. Someone who bought a house in like 1978, they're like, you need to put 20% down.
You got oh my God, your Grandpa Joe. Well, in my day, we walked off the farm and we put 20% down on a house and we bought the house straight from the bank, right?
Those houses were like $60,000 at the very most.
Your Grandpa Joe's house was $60,000
and Starbucks didn't exist.
And Starbucks didn't exist, right. Yeah. Because your
Netflix.
Grandpa Joe could build his own house. Do you guys understand? Back in the day, they had the knowledge of how to build their own homes. We don't have that knowledge. Most of you watching this don't know how to build your own home.
Can't change a tire.
Exactly, which means you are completely dependent on the home builder, right? So the prices of houses, as you guys know, have gone up. 20% on a $300,000 house is $60,000. $60,000. Okay, let me show you guys this. 20% on a $300,000 home is $60,000. $60,000. Okay? Would you guys rather pay $60,000 out of your own pocket, or would you rather use equity to pay off this $60,000? Right? Be honest with yourself. Would you rather pay $60,000 from your own pocket, or would you rather let your house get the money for you and you use the house's money to pay it off instead of using it from your own pocket? Doesn't that make more sense? This is why we go with the FHA loan and we refinance into a conventional loan. Instead of putting 20% down from the jump, which is a lot of money out of your pocket.
It's a lot of money for a $300,000 house.
Oh my God, Nika, you could not be more correct. You guys, putting down $60,000 for a $300,000 asset doesn't make sense. That doesn't make sense. You're putting down $60,000 for a $300,000 home. Those numbers don't add up, right? Do you know how long it would take that $300,000 home to return your $60,000 in value? Forever. Even if you're saving $200 a month on your mortgage, that's $2,400 a year. You would have to stay in that house for almost 25 years to get your money back. That's crazy, right? It makes more sense to put down 3.5%, let the equity build, and then use the equity to pay off the $60,000. Much easier, much easier.
Well, that's a huge difference between FHA loan and conventional, is the money that you have to put down too.
Yes.
Yeah.
Yes, 100%. With a conventional loan, you can put down as little as 3%. You do not have to put down 20% on a conventional loan, but getting the 3% qualification means you have to have really good credit and really good debt to income to get 3%. I'm just being honest with you guys, okay? Austin, can you check the TikTok and see if we have any good questions? I'm usually doing feedback with my TikTok audience, but the camera's far away today so they can see me.
Yeah, so a lot of people, there's like an argument going on because one guy's trying to say that you're trying to scam people like in 2007.
Oh, we have a troll? It's okay.
Yeah.
It's okay. That's okay.
But
Ignore
no, questions not so much. It's more so people handling the troll.
Oh, good.
Yeah.
Good. So no,
You got soldiers.
No actual questions in there?
None that are like the actually, there's a lot of like basic ones like, how can I get a mortgage loan?
That's okay. Hey, to get a mortgage loan, you guys, it's very simple. You have to speak to a mortgage lender. A lot of you guys think you have to go to the bank to get a loan. You don't have to do that. You don't have to go to the bank to get a loan. You go to a mortgage lender, a local mortgage lender. They're usually going to give you better rates and more competitive rates. That's the truth. All right. So the next thing we want to cover today is what changed with the FHA loan. What changed with the FHA loan? One of the biggest misconceptions people have, Nika, and I'm sure you face this all the time. People think that the interest rates go up to hurt the middle class or to hurt lower income people. They think that. They really do. The interest rate doesn't go up to hurt you. The interest rate goes up to hurt people with a lot of money. I really need people to understand that. The interest rate doesn't go up to hurt you. The interest rate goes up to hurt people with a lot of money. How so? Well, pretty easy. When the interest rates were 2 to 3%, rich people know that equity gains at an average of 5 to 8% every 5 years. They're buying the house for free. Would you guys like to know what happened during 2021? Rich people who owned homes realized they could take their equity in their homes and just buy 2 or 3 homes at a time. Why? The interest rate was so low. When the interest rate is 3%, you guys, rich people are buying houses for free. So what happened during 2021 is you had very wealthy people or people with a lot of equity buying 2, 3, 4 homes at a time. And they were raising the price of these homes. Why? Because the interest rate was so damn low. When the interest rate's 3%, you're borrowing money for free. So the interest rate doesn't go up to hurt you. The interest rate goes up to stop wealthy people from buying every single home on the market.
Yeah, when the interest rates were really low, a lot of the like you couldn't really beat any of the offers that were
No.
coming in. You can't beat $30,000, $40,000, $50,000 over
How can
asking
you?
price.
How can you? To a rich person,
Right.
a rich person,
A rich person could, but
paying 50,000 over means nothing to them. They're borrowing that money from the bank. They don't care. It's not their money.
Right.
They're borrowing it from the bank. The interest rate is 3%. The house is gaining 5% equity. They're making money. They don't care. They're buying the house for free.
now that the interest rates are up, everybody has a better chance of getting a home.
Yep. Have you guys noticed with the interest rates going up, houses are going below the list price? Have you guys
Below,
noticed that?
They're offering concessions.
Yeah.
Like they were not doing that when the interest rates were at
They
2
weren't.
and 3%. No
They
way.
weren't. You guys are getting a much better housing price with the interest rates going up, which is important because the FHA loan, as we discussed earlier, is what? It has an income cap. The FHA loan in Las Vegas is $495. Well, if houses are going $20,000 above their list price, you don't qualify with your FHA loan.
That means you can't look at a house that's $490. Now you're going to have to start looking at homes
Yep.
that are lower than what you like $470. And
This is facts. This is facts. In 2021, if my client was approved for $450,
you're not looking at $450.
we were looking at houses at $425.
Yeah.
We were looking at houses at $425. That's what happens when the interest rate is at 3%. You can't look at houses that you can afford. You have to look at houses cheaper than that, right? All right, we're going to do a little math, which I know everybody hates.
You're going to lose me on that one. So go
I
ahead.
know, but you guys need to see the money that you're getting with equity, right? You guys have to see this. So what we said is your house gains about 5% equity every year over a 5-year period. So here's what these numbers look like, okay? You have a $400,000 home. You put 5% down, which is $20,000. Everybody still with me? Good. That means the loan is $380,000. You took $400,000 and you subtracted $20,000. Are you guys right? Okay. 6% of this loan is $22,000. That is, when you add it on to here, your house is now worth significantly more than what you bought it for. Okay? What I do that is for you guys to see how that compares to rent. When you take $2,000 in rent per month, okay, over 2 years, you have spent $48,000 with 0% equity. Whereas your house gains 5%, right? Whereas your house gains 5% and grows in value, your rent continues to go up and you gain nothing for it. Here's a huge rant we're going to go on, and you guys need to hear this. People always tell you guys the interest rate is too high, okay? People always tell you the interest rate is too high. What I like to say is, okay, what is your option B? Your option B is renting. And I get it. If renting prices went down, if rent was super cheap right now, that advice would be really good. If renting a house was $1,400, that would be great advice. But we are literally in the worst rental market of all time. Your rent goes up $100, $200 every year.
At the very least.
At the very least. How is that a good option? How?
Everyone's worried about the interest rate when, meanwhile, when you're renting, you're paying 100% interest.
100%. Thank you. It's 100% interest. Think about this, you guys. Think about this, okay? You rent a house that's $1,800 a month. The next year, it's $2,000 a month. You're paying more, but you're getting the same exact house. How is that fair? How is it fair that you're paying more money for the same exact house? When you buy a house, it's the same exact house, but it's worth more money every year. Do you see the difference? When you're renting, you get the same house every year, and it costs you more money every year. When you buy a house, it's the same house, but you make more money every year.
So actually, I'm working with a client right now who is in that predicament where she's paying $1,000 a month for rent, which is amazing. Like
Sure.
we're not gonna be able to beat that.
Sure.
But she's paying $1,000. She's been paying it for the last 10 years. So if you do the math, $1,000 times 10, that's a lot of money to be putting towards somebody else's house.
Yeah. I'm just here. That's a perfect. People who are paying under market rent, you're paying $1,000 a month, and you're like, oh, I'm kicking ass. Okay. After 12 months, you have paid $12,000. After 10 years, you have paid $120,000.
That's a lot of money.
Think about that. How are you winning? If she had bought that home when she started renting, instead of spending $120,000 and making nothing, over 10 years, she probably would have gained anywhere from like 25 to 50% equity in her home.
Right.
Just
it's
off
a townhome in
averages.
Summerlin too.
That's crazy.
Yeah.
Just off the law of averages, the average home gains 5% equity over a 5-year period, which means over a 10-year period, if you extrapolate that out, you're anywhere from 40 to 50%. Now, nothing is guaranteed. We're just going off averages, but it's such a large number. It's such a large percentage of homes that gain equity that we're allowed to use these averages, right? So the final part of this puzzle is you take out the FHA loan and you're worried about the interest rate, the interest rate, the interest rate. Everybody's worried about the interest rate, okay? Here's some things you guys need to know about the interest rate. You can use your own money to buy the interest rate down. It's called discount points. Okay. I don't want to get too nerdy with the math because I've already mathed you guys out a little bit today, but discount points are 1% of your loan. So let's scroll up and use the loan from above. Okay. So your loan on this property was $380,000. Each discount point would be $3,800. Pretty simple, right? Now you're saying, well, Brandon, I don't want to use money out of my own pocket to buy down the rate. Great. You can use the seller to pay to buy down your rate. Nika, have you been doing this?
Yep, that's what we mean by seller concessions.
Yeah. The seller concedes money to you for closing cost. You can then use that money to buy down your interest rate. So for instance, I'll give you guys an example of a contract that I just wrote. Okay. The house was $450,000. Our loan was $420,000. Each discount point was $4,200. So guess what we did? We asked the seller to contribute $16,800 to my buyer's closing cost. That's 4 discount points. We bought his interest rate from 6.5 down to 5.5. We lowered his mortgage permanently, and we used the seller's money to do it.
Which it doesn't seem like it's a lot, but it's only a point, but that's a huge monthly difference.
Oh my God. Here, let's show him.
So, and people people focus so much on how much they're getting the house for. And really it's the interest that's going to kill 100%. You on your monthly.
You guys, the difference between a $450,000 house and a $425,000 house is like $50 on your mortgage. You guys obsess over the list price. The list price means almost nothing in terms of real estate. Honestly, you getting a $450, let me tell you how little it means. My commission on a $450,000 house versus a $425,000 house, the difference for me is like $100. For those of you guys who think realtors are always trying to sell you the more expensive house, we're not. The difference on that commission is like $100. We literally don't care. Okay. And it's like $50 on your mortgage. So here behind me is a mortgage calculator. I'm going to show you guys the difference in how big an interest rate can mean. So we have a $400,000 house here at a 6.7 interest rate. All right. When we do the numbers, it comes out to $2,300 for your mortgage. When we go to a 5.7 interest rate, instead of $2,300, it goes down to $2,100. So just by buying your interest rate down 1 point, we saved you $200 a month on your mortgage. That is where the value is, you guys. So if you're worried about interest rates, don't worry. Using the FHA loan, you can buy your interest rate down a significant amount. All right. And then finally, as we discussed earlier, you can use the equity your house makes year after year to lower your interest rate. All right. You can use the equity your house makes year after year to lower the interest rate.
You cannot do that when you rent.
You cannot do that when you rent. No matter how much you pay to your rental, it's still going to go up.
No matter how much your landlord loves you and you have a great relationship with them.
Yeah. Hi, mister. Your landlord will be like, listen, I love you so much. I bought you a pizza. and I helped you fix your water heater. My home warranty company paid for that, by the way. Your landlord pretends to love you. He pretends he's your best friend. Ask your landlord, hey, if I pay a full year's rent, will you lower my numbers? Fuck no. Your landlord loves you so much, he's only going to raise your rent $100 instead of $200. You understand? Your rent is never coming down. No matter what you do, your rent is not coming down. When you own a home, you can use the equity that your home gains to refinance and lower your interest rate. And you can do this constantly. Constantly. Okay? That is the FHA loan. Do we have any questions, Austin? Anybody have any questions on the FHA loan before we move on to the real estate is dating segment?
So a question that keeps popping up that I found interesting, not necessarily about an FHA loan, but they said, at what point do you know when you're ready to go talk to a realtor?
Oh my God. Easy peasy. So you guys want to talk to a realtor the second you decide that you're serious about buying a home, right? The reason for that is
Not when you want to move.
not when you want to move, the second you decide you want to buy a home. Realtors know all the good lenders. You guys always say, oh, Brandon, how do I find a good lender? Well, that's my job. I know all the good lenders. I know the ones who give the best rates, who have the lowest prices.
And we do not get kickbacks for any of this stuff.
No.
No.
I'll recommend you 5 different lenders. I don't care which one you use. They're all good. So when you're ready to start looking, you talk to me. I'll recommend a lender. The lender will ask you, here, I'm going to save you all time. Here are the questions that the lender is going to ask you. Have you been in the same job for 2+ years? The same profession. If you're a mechanic, have you been a mechanic for 2+ years? That's the first question he's going to ask you. The next question is, what's your current credit score? Right? Then you're going to fill out an application where you give him your financial information and your tax history. That's it. So you know you're ready to start looking for a home or speaking to a lender when your credit is 640 plus, when you've paid your taxes, and if you've been at the same job, the same profession, not the same job, the same profession for 2+ years. If you have all 3 of those qualities, you're ready to speak to a lender. Even if your debt to income is a little off, the lender can tell you how you can fix it. A lot of you guys are paying off debts that don't really matter. Speak to a lender. The lender will tell you, pay off this debt. We don't give a fuck about your medical bills. Pay off this debt over here. All right?
Another question was, how can we use the equity to lower the interest rate?
Easy. You go to, okay, perfect example. I'm going to do it on the board for you guys so you guys can see behind me. Your house was $300,000 at a 6.5% interest rate. Okay? That's you. That was your house. Okay? 2 years later, your house, 2 years later, someone in your neighborhood sells their home for $350,000. So you look on Zillow and your neighbor just sold their home for $350,000. This is when you call your lender and you order an appraisal. An appraiser will come out to your house. He will go over your statistics and he will compare it to the neighborhood around you. And he'll say, wow, your next door neighbor has a smaller house than you and they sold it for $350,000. And they'll do an appraisal and they'll say, man, your house is worth $360,000. Now your house is worth $360,000. It's not a guess. When you guys get an appraisal, it is not a guess. The appraiser is telling your lender your house is worth $360,000. So you go to your lender and you say, hey, I bought the house at $300,000. It's now worth $360,000. I would like to take $60,000 of my equity and use it to buy down my interest rate or refinance my loan. And there you go. That's how you use your money. You get an appraisal, you see how much equity you have, and then you use that equity to your advantage. All right? Hey, producer.
Yes, sir.
You bored of us? We got any other questions?
No. I'm responding to texts that I'm getting from other clients. I apologize, sir.
Other clients.
Other
Okay.
clients. Big man. Big man.
So-
Hey, flip. You can flip Instagram around. We have Instagram Live too. I don't know if anybody has any questions on Instagram.
Oh, okay. We did get one that just said, how do I see it? It says, what's a few good questions to ask a lender? Do they mostly charge the same?
Oh, you want to handle this?
No, you got this.
All right. Here are questions that lenders are going to get so mad at me for telling you guys, but I'm going to hook you up. 1, what do you charge for origination fees? Do you guys know this is where lenders make a lot of money? They charge you an origination fee to find a rich person to buy your loan. The lender doesn't have the money. They have to find a source, a bank or a big time investor to fund your loan. And they charge you money. They basically charge you a finder's fee to do that. Well, guess what? I have lenders who don't charge anything for origination. This is why you want to speak to a realtor, because we have lenders that fit every criteria. So the first question you want to ask a lender is, what do you charge for origination fees? The next question you want to ask is, how quickly can you close my loan? 30 days is average. 21 days is good. 18 days is a good frickin' lender. Okay? Great. Now, here's what you guys need to know. Lenders who can close in 18 days are going to be more expensive than lenders who can close in 30 days. That's pretty obvious, but you guys have to know. It's rare that you're going to find a lender who can close in 18 days who's also cheap, because it's expensive on their end to close you that quickly. So the first thing you want to ask is, what do you charge for origination fees? The next question is, how quickly can you close my loan? The last question you want to ask is, origination loan, what will I pay for discount points? And what rate can you get me without them? All right. I'm going to expose a huge lending trick right now. Okay? You guys call a lender and you guys say, this lender over here gave me a 6.5% interest rate. Can you do better than that? And that lender will say, of course I can. I'll give you a 5.8% interest rate. What they're not telling you is they're going to charge you a bunch of discount points to give you that rate. They're not really giving you a better rate. They're charging you more money on your loan to get you that lower interest rate. It's a huge lender trick. They all try to pull this trick, and I'm going to save you guys time. Ask the lender, what is my interest rate without discount points? Because with discount points, I could get you a 4.0 interest rate, right? If you're willing to pay $40,000, I can get you whatever interest rate you want. You have to ask the lender, what rate can you get me without discount points? All right.
Next question is pre-approval lender specific, or do you use the same pre-approval to shop your loan?
Is pre-approval lender specific?
So I think they're wanting to know, do all lenders use the same criteria to pre-approve you, or are they?
Yeah. You guys, no matter what lender you use, they're all using the same pre-approval. What's your debt to income? What's your credit ratio? How much of a risk are you? They don't want another housing crash. Lenders got a really bad and tarnished name from the housing crash. People realized that lenders were ripping them off left and right. They don't want to risk a housing crash. So every lender is trying to assess, how much of a risk are you? Okay? No matter which lender you go to, this is what you're going to be dealing with. All right? Nika, lending is the worst part of real estate. It's the most boring part of real estate. So let's get into the most fun part of real estate. Okay? Everybody who tuned in for the real estate class on Instagram and TikTok, I thank you. In fact, I'm going to come over to the TikTok right now and try to speak to you guys really quickly, because you know what time it is. Real estate is dating, and dating is real estate. YouTube live only. You guys, we will only be running this segment on YouTube live. I'm going to go chat up the TikTok really quickly and thank them for their attendance today. If you guys want to join in on the Real Estate is Dating, Dating is Real Estate, we're doing it on YouTube Live only. You can find my YouTube in my link tree in my bio, or just head to Brandon from Vegas YouTube. Very easy to find. We'll give you guys about 5 minutes to transfer over. I'm going to go talk to TikTok really quickly. Thank you guys. This was really, really fun.